Welcome to my Accounting 1120 continuing discussion on the topic of investments. My goal is to compare different investment categories, but I want to focus on accounting for investments in stock that are greater than 20 to 25% of the common stock outstanding of the investee. The goal of the investor is assumed to have obtained what we call significant influence. And they're no longer a casual investment. They are trying to influence the running of the business of the investee that they are invested in. Before I do a comparison of the categories, which I think is good for us in this chapter, I want to talk a little bit about how the significant influence method works. First, let's focus on the investee, that is, the person who the investor is planning on investing in. Under this method of accounting, the investor mimics what's happening in the investee's retained earnings account. So I have the investee listed here, the person we're investing in, and their balance sheet, assets equals liabilities, the stockholders' equity, and I'm focusing on the investee's retained earnings account. Now let's look at where we are on the investor. The investor has an account in their general ledger. It's an asset, and it's a long-term investment. Under the significant influence method, we use the equity method of accounting. And it kind of tells you what's going to happen to your investment account. Whatever happens to the investor's retained earnings happens to the investees in their ownership percentage. So let's assume we own 30% of the stock. Retained earnings for the investee will go up for net income, and our long-term investment account will increase for 30% of the net income as though we actually own it. The investee's retained earnings will go down when they declare a dividend, and when we receive the dividend, as the investor, we'll take 30% of it and drop our investment account by that. So we go up for 30% of their net income and down for 30% of their dividends. And in fact, anything that happens to their stockholders' equity retained earning account is mirrored at our ownership percentage in our investment account. So with that in mind, let's start our categorical review and then some accounting with some facts. Let's review our categories quickly. Of investment. I know you're tired of it, but this is good for you. In our first category, we have the two types of investments we mark to market. That year-end adjustment, and that is trading and available for sale. So this is the type of investment. We also had hold to maturity. What we were investing in could be stocks or bonds. On the mark-to-market, it could be either one. But if it were really short-term, it were trading. And if it were management's intent to hold it for a while, it would be classified as long-term. So that's our mark-to-market category. Those are stocks or bonds. Then we look to hold to maturity. And that could only be bonds, because only bonds have a maturity date. And although they could be short-term or long-term, almost always they're long-term unless it's the year that they mature. And now the category we're going to look at. In our example, we're going to look at the significant influence category. It's equity method. It's the accounting type. And it's in common stock where your ownership is greater than 25 20 to 25%, and you have set out to influence their management techniques. How about some facts? Shall we get some going? So here's our facts. We purchased 10,000 shares of common stock of a company, 30%, and it's deemed that significant influence does exist. 20 to 25% is just an earmark, but we're saying it exists in this case. The company that we purchase earns net income in the amount of $50,000 for the year, and they pay a dividend of $10,000. This investment costs us $150,000, and the year-end price per share of this investment is $20,000. How would we do the accounting for this? Well, first, let's record the purchase of this investment. And we said the purchase of it was $150,000 a share. So we would say debit long-term investment. Your author didn't say you had to put equity method on it or significant influence. I'll go ahead and put that there. I don't think he does. And you pay cash in the amount of $150,000 for this investment. And so you've recorded the purchase. During the course of the year, you earn some dividends. Or rather, the company pays some dividends. Let's change that word. I don't like the word earn. They pay dividends. We look at this as almost as a return of capital. They pay a $10,000 a year dividend. Our share of that $10,000 is 30%. So we're going to get $3,000. We look at that almost as a return of capital of our investment. So we'll debit the cash because we get that for $30,000 or for $3,000, and then we'll credit long-term investment, dropping our investment in this equity investment by $3,000. When they pay a dividend, it drops their retained earnings. So when we receive it, it drops our investment. It says the company earns $50,000 of net income for the year. So our last entry is to recognize our earnings from this. Now, we didn't get any of that net income in the amount of $50,000, but we're saying 30% of it's ours. So if they have $50,000 of net income, we're saying 30,000 of it's ours, or 15,000. Net income makes their stockholders' equity bigger, so I'm going to make my investment bigger. I'll say long-term investment under the equity method. My 30% of that's 15,000, and I'm going to call that investment income, oddly enough, and show it on my income statement as income. And again, that's my 30% of their net income. I want you to pay attention to what's happened in my long-term investment account. I started by buying this investment for $150,000. I recorded that at cost. When they paid a dividend, I reduced my investment by my share of it, saying it was a return of a capital. And when they had net income, I increased my investment account by my share of it, saying it actually belongs to me. So my balance in this account is $162,000 at year end. It went up for their net income and down for dividends. What happened on the investor's balance sheet and retained earnings? Now again, remember, this is the investee, the person that I was investing in. Their retained earnings started at whatever it was, and it went up for $150,000 in net income. and it went down for dividends in the amount of $50,000. I picked up my 30% of their net income. I said 150, I meant 50. I picked up my 30% of their net income, and I picked up my 30% of their dividends. Went down for it. So whatever's happening in their retained earnings account is being mirrored at 30% in my investment account. Let's move forward. Say, what would it look like on my income statement? Again, I'm the investor. What would my income statement look like? Let's assume 2013. And I would have investment income from the equity method, probably called affiliated income, in the amount of 30% or $15,000. And I would actually show that as income. So much so that that would get closed into income summary when I did my closing entries and increase my retained earnings. So I literally picked up that amount of their income. How would it look on my balance sheet? Always good to know. Here's my income statement. Here's my balance sheet. Long-term investments. I would show in the amount it ended for at the end of the year. It was $162,000. If you'll recall, that was my initial investment plus 30% of their net income minus 30% of their dividends. Note, I gave you the market value of their stock at year end, but you do not mark to market. The only thing you do mark to market in is trading and available for sale. The equity method, you just leave where it is. So now, under the equity method, what I have is a long-term investment that started at 150, went up for net income, and down for my share of dividends. Did that backwards, up for net income, and down for my share of dividends. Aren't I cute today? $162,000. If you recall, that represented I own 10,000 shares of their stock. Boy, I'm having a hard time, huh? I own 10,000 shares of their stock, which is roughly $16.20 per share cost should I sell it. The fact that its market value was 20 bucks per share didn't matter. I didn't get into this investment for the short term. I got into it for the long term. It is not for sale. It is for influence. Hey, thanks for joining me for the significant influence method. We'll talk about this in class.